The regulation of interbank lending rates. The regulation of interbank lending rates by the central bank can significantly impact the cost of credit in Kenya. Interbank lending rates refer to the interest rates at which banks lend to each other in the interbank market. These rates are crucial for maintaining liquidity and managing short-term funding needs. Banks with excess funds lend to other banks that need liquidity. Conversely, when banks face a shortage of funds, they borrow from other banks. The interbank market facilitates risk sharing and liquidity transfer among banks. Impact on cost of credit. The regulation of interbank lending rates can influence the overall cost of credit in several ways as highlighted below. Liquidity provision. By regulating interbank rates, the Central Bank of Kenya can ensure sufficient liquidity in the banking system. When liquidity is abundant, banks can meet their funding needs without resorting to expensive sources of financing. Lowering borrowing costs. When interbank rates are well regulated and stable, banks can borrow from each other at reasonable rates. Lower borrowing costs for banks translate into lower costs for borrowers, individuals, businesses, and corporations. Transmission mechanism. Changes in interbank rates affect other interest rates in the economy, e.g., prime lending rate. Commercial banks often set their prime lending rates based on interbank rates. A reduction in interbank rates can lead to a decrease in the prime lending rate, making loans more affordable for borrowers. Consumer loans. When banks pay less to borrow from each other, they can pass on these savings to consumers by offering lower interest rates on personal loans, mortgages, and other credit products. Business loans. Similarly, businesses benefit from reduced borrowing costs, which can stimulate investment and economic growth. Risk management. Regulated interbank rates contribute to better risk management. Banks can plan their liquidity needs more effectively, reducing the likelihood of liquidity shortages or excessive borrowing during financial stress. Stability. Stable interbank rates create a predictable environment for banks and borrowers. This stability encourages long-term planning and investment. The central bank has implemented reforms to regulate interbank rates. Lowering rates. The interbank lending rates are expected to stay under 1.5% of the prevailing central bank rate, CBR, down from 2.5%. In addition, the discount window rate, used as a last resort for banks, has been lowered to 3% above the CBR. These reforms aim to enhance liquidity provision, reduce borrowing costs, and promote stability in the financial system.